And see you join. How you doing?
Oh, no worries. Hey, Vincent, how's it going? Doing well. How about yourself?
Good, yeah. How's the change of career been going and everything?
It's good. It's busy. It's a whole new game. So it's like
Yeah,
it's a lot more time management than anything else. Make my own schedules,
yeah.
stay on top of it. A lot of phone calls, a lot of meetings, but it's been fun so far.
It's good to hear, yeah. I mean, I don't think Professor Zora is here at the moment, but I can just go ahead and get started. Uh, yeah, so just catching up again on our multi-factor investing project. So big thing that's of the last 2 weeks, we have two new group members, which is great because we've been trying to get some new members on, but unfortunately we've had about three people plan to join and then they end up not at Lehigh from visa rejection or such. So that's kind of sucked. So it's nice now to have two members that are here already. And Nate's involved in the MFE program, Sethu's a sophomore in IBE financial engineering. Nate's in the call, and then Sethu has a class currently, so she's going to be late. But Nate, if you want to just say hi real quick.
Yeah. Hey Jordan, I was listening in on the last call with you guys too. So yeah, excited to join. Excited to see what's going on.
Awesome. Yeah, pleasure to have you. Have you join the team?
Yeah, so obviously that's great. Great to have new faces and everything. And then of course, me and Shadid have been here for a little bit of time now. And then as far as just a general overview for anyone on the call that's less familiar, as it's called, multi-factor investing, it's based on a FAMA French framework. So multi-factor just means you're utilizing factors to try to drive your return stream and your volatility metrics. Basically, you're explaining your risk return trade-offs through factors. And the FEMA French factor framework specifically is a multi-factor framework, but it's focused on market, size, and value factors. And then these three factors are going to essentially try to explain where your returns and where your risk is coming from. As far as what we do, we generate optimal beta points through a learning model, and that decides how we allocate our equities to fit the specific optimal Fama French beta points. And this learning framework is based on a Sortino ratio maximization. So typically with our models, the points we're going to be using are generated and focused on trying to maximize the Sortino ratio. And lastly, our portfolios are dynamically rebalanced. That's kind of been what we're going to likely go with going forward. We could improve the amount of points we have access to for dynamic rebalancing. But as far as what we have now, we're just going to keep it at dynamic and then try to also improve that while we essentially work on other things. So dynamically rebalanced either yearly or monthly to these optimal beta points that we already have generated. And as far as specifically what this presentation is about and what we've been working on for the last few weeks. So the main question we kind of have, and I guess one of the, if not the main goal of this project is to say, are the results market driven due to consistent, strong S&P 500 performance, or are they factor driven? And maybe I should have mentioned this on the last slide. Our tickers and how we're generating our portfolios are based on exclusively S&P 500 tickers. So it's kind of hard to separate yourself from, well, are we actually doing something productive and actually gaining excess returns, or are we simply just banking on the fact that the S&P 500 has performed strong and pretty low volatility for the last 20, 30 years? So it's definitely hard to really separate that and make a judgment call. But the way we're attempting to do that is by comparing our model and the performance of our model on US market equities versus Indian market equities. So the idea behind that is the US market has, all these macroeconomic factors. Say the COVID crash was huge for all equities and all markets, but US market specifically. Um, they say like the 2020 market, a bear market where we lost about 15% in the S&P 500. Well, the Indian market doesn't have the exact same cyclical nature at certain times. Say 2020, for example, S&P 500 lost 15%. The Nifty 50, the 50 largest tickers in the Indian market, they actually gained anywhere between 5 to 8%. So there's just overall a lot of different different periods and different year performance. So when we run our model instead on these equities, it's going to give a healthy understanding of what our performance is when we take away the internal intrinsic nature of US equities. So to start off with strategy comparison, we're going to start off with the Nifty 50 versus the S&P 500. So the 50 biggest Indian market tickers versus the 500 biggest US market tickers. That's the universe where our portfolio is choosing stocks from. And then we're also going to have a comparison between our models ran on both of these universe selections, first yearly rebalancing and then monthly rebalancing. But to start off, it's really important to consider how the markets actually differ. So, like I mentioned, they are overall slightly similar, but they do have some key differences. Of course, the main thing that jumps out is the outperformance for the Nifty 50. You're looking at about a double or a 2.0 ROI from 2020 to the end of 2024. You're going to see a couple points of diversion. I think 2020 is kind of the main one. You're going to see actually solid performance for 2020 versus the US, or excuse me, the S&P 500, which dipped pretty bad in 2022. And additionally, the COVID crash of 2020, you see the Nifty 50 market dipped even stronger than the S&P 500. So definitely a lot of areas where there's going to be some differences. And that's pretty important because if we have an uncorrelated baseline, then maybe not any, but a good amount of excess correlation between our portfolios on the S&P 500 and the Nifty 50 is going to be a really good sign. So again, just comparing the portfolios, I think this is where you can get a lot of insight from. You see very little overlap, very little consistent overlap, rather. You see not many back-to-back points staying pretty close and you're overall just going to see the strong difference. I mean, another key thing to look at is the Nifty 50 market is a bit more volatile. Obviously, it has excess returns, but um, definitely just a lot more movement around the Nifty 50 market. I think it's about 3% higher volatility in this period. But yeah, overall, you don't see much correlation. Obviously, eye test only goes so far, but you can kind of just get a good understanding of how unrelated the markets can be due to the fact that they're just completely or almost completely unassociated indexes, unassociated markets. Just going to be a lot of different factors based on regime changes and just internal issues of the specific country's markets. Now, when you compare our portfolio runs on yearly dynamic rebalancing first, or sorry, all yearly dynamic rebalancing, but the Nifty 50 universe versus the S&P 500 universe, one main thing that jumps out, huge outperformance for the Nifty 50 optimized portfolio. I mean, a big part of that is likely the fact that these tickers from the Nifty 50 market on average have performed better in this period. You saw that just 2 slides ago when you see significant better performance from the Nifty 50 versus the S&P 500. And I think more so it's important to look at just kind of where the overlap is. I think you can see basically the first 4 months of 2020, nearly identical performance. That's pretty interesting. And then additionally, there's definitely some pattern formation. Obviously, it does diverge at some points, especially at the end of 2024. But it's probably better to ignore the return on investment because that's not necessarily what we're looking at. We're trying to look at the correlation specifically through the monthly returns. And this is where you can definitely start to see a good amount more of just basic eye test correlation versus the S&P 500 and the Nifty 50 market. And again, especially in the first 4 months of 2020, it is very close to identical. That's something that we found very interesting. And then additionally, you see a lot of points where maybe the S&P 500 dips a bit more, but the Nifty 50 universe, or excuse me, the Nifty 50 portfolio is also dipping. So although not all the points are going to be online, they're going to kind of follow the same pattern, and that is almost always going to lead to higher correlation. But we'll get to correlation at the end. When you look at it on a monthly dynamic rebalancing focus, this is where you see one insane performance from the Nifty 50 universe selection, which is again not the focus, but it's always going to be a good thing. Good performance is always going to be good. But then additionally, you definitely start to see a bit more pattern forming. I think when you look at anywhere before so it's anywhere before 2023, you definitely see just pretty consistent, I guess you could say curves when the Nifty 50 universe portfolio is dipping, the S&P 500 universe is also dipping, so to speak, most of the time. And that's something that's exactly what we're looking for. We're looking for that more correlation. And again, when you're looking at the arithmetic returns, it is pretty similar to the yearly dynamic rebalancing, but overall, there's a bit more pattern formation here, at least according to my eyes. Because when you look at first couple months, you see pretty similarities, first couple months of 2020. And then again, when you're looking at like say 2022, you definitely just see similar pattern formations. Like they might not be on the same line, they are moving in the same direction, and that's going to lead to strong correlation. And you definitely see a lot more of that with this, which is exactly what we're looking for. And then when we move on to just the actual correlation, I talked about eye test, and that's always something that's going to be helpful. But at the end of the day, you can't, get judgment, make conclusions from just looking at a graph. You have to actually get numbers from it. So before we even look at it, the hypothesis, or rather what we'd expect slash want, is going to be better correlation of the portfolios versus just the indexes. So when you look at the S&P 500 compared to the Nifty 50, we already talked about they didn't look very correlated at all. Well, a correlation is 0.07, which is extremely close to zero, little to no correlation between the two indexes. So what we now would want is when we're taking away the internal intrinsic US slash Indian market drivers, when you take those away, then our portfolio should be using the factor framework to choose specific equities to follow what it's being modeled to fit. And then it's going to have excess correlation because of that. So essentially, you're taking away just the natural movements of the indexes, and then your factor framework, excuse me, our factor framework is going to actually be more correlated because it's taken away this lack of correlation that the two indexes have. So as far as the yearly dynamic correlation matrix, it goes from 0.07 to 0.61, which is much higher and definitely shows that there is a strong amount of factor-driven performance, which is exactly what we want. Now, yearly dynamic rebalancing is good, and we'd expect that to be a bit more correlated, but overall, we're going to expect monthly dynamic rebalancing to be more correlated because your factor tilts are going to shift much less because you're rebalancing every month as opposed to every year. So it's going to be more aligned to your factors, which should mean more correlation. And that's exactly what you see. It's not significantly more, but still a gain of 0.06 is a significant amount or a good amount of excess correlation. And that's exactly what we'd expect when we go from yearly to monthly rebalancing. So this is all really good signs that upward trend as we rebalance more of uncorrelated indexes is definitely something that really shows that a lot of our results are factor driven. And just to wrap it up, essentially, what does all this mean? What's our conclusions we're drawing from this? So, one, index correlation. The indexes at core values, just the indexes themselves, are not particularly correlated. 0.07 is not very high. Any type of US equity market, say the Russell 1000 versus the S&P 500, is going to be pretty correlated up to probably zero point 0.6, zero point 0.7, zero point 0.8 range. So it's good to see that we're able to work our model on two uncorrelated indexes because that's where we're going to actually get insight from. And as far as how the indexes work, they're diversified to their own markets. They don't have the same return of volatility streams. So then when we have our own kind of return streams in terms of monthly returns, that's going to be really good for gathering insight. And why all this is even possible, like what is actually driving that excess correlation? Well, our factor framework, portfolio construction, strips away the macro and the cyclical swings. It's taking away the intrinsic returns of the index, at least a good amount of them, and actually deriving the return stream from the factor framework and allowing it to be something that is explaining a good portion of the returns. And we kind of are saying now that our returns are primarily factor driven. Obviously, the correlation isn't 100%. It's not 100% factor driven. We can't just plug this in anywhere and predict, the return stream, the monthly return volatility, and all that. But we do have a much better idea of it now. Now, like I said, it's not at 100%. It'll never be at 100%. But how can we improve that correlation? What can we try to do to get that even higher? Well, one key thing we noticed with this specific example is our optimizer only utilizes anywhere between 8 to 12 of the equities of the Indian Stock Exchange of the Nifty 50. So I could get into why, but one way or another, we're trying to fix that, or it's not like it's an error. We're trying to change that so we can utilize, say, all 50 of the Nifty 50 index. And then once we have a better sample size of equities, we're not just using 8 to 12 of them a period. That can really probably make it so our return stream is more factor based because we're touching all of the equities. We're not just grabbing a few that are close to our beta points. So once we expand this range, it will allow for more factor driven diversification, and that would likely improve the correlation. So that's something we're thinking about now. We're working on it now, I should say. And, we're going to do that, look at it and see if we actually are improving the correlation from that. And if it is, that's even an even better sign saying that our returns are pretty factor driven because the more stocks we're using, the more the more diversified it'll be, the more aligned it'll be to our factor loadings. And that would increase diversification if, excuse me, that would increase factor-driven performance if our multi-factor framework is actually primarily factor-driven. So definitely just a good something to look at, and we're going to be working on that for uh, our next step. So yeah, that's all we have.
Yeah, no, I love it. I mean, like, to simplify things, we tested a hypothesis, it worked.
Mhm.
You know,
Yeah.
it's as expected, but it's pretty cool to see the results. It's like to generalize it, just to like give more context on it. It's just like if you run the CAPM model, right, or you run like a multilinear regression with a three variable approach, you get an R squared of like 0.95, which means there's very little idiosyncratic risk that you can't predict. So what happens if we take the exact same model, the exact same like betas essentially, like tap into that correlation power, but just switch all the stocks, we should get a pretty similar return stream. Obviously, like when you compound and accumulate it, like it wasn't that
Yeah.
simple, but like the monthlies were pretty similar, and the correlation's much higher. So like, yes, like is it as similar as we were hoping it to be? Like no, but like it's also just the first or second iteration. Like
Exactly.
we're getting closer. But yeah, that's really interesting, and it looks good.
Yeah, I mean, that's where like I mean, you say this a lot, so it's logical, but ROI just kind of sucks sometimes. Like obviously it's like the most intuitive graph to look at. It's the, most pleasant to show and view. But at the end of the day, like those return streams basically mean nothing when we're working with this. I was about to not even include them, but I think it is important to kind of just have a something that's easily to understand, easy to look at. But again, yeah, like it almost like takes away from the fact because it's so unrelated to the actual correlation. They don't look correlated at all when you're looking at, a 3x ROI versus 2x ROI. You would think they're not going to be very correlated. They're actually 0.67 correlated. So it's definitely something that is surprising, so to speak, when you first just look at the ROI graph. And
Mhm.
yeah, I mean, we definitely think that it could be more correlated. We're not like changing our focus to just trying to make these correlated, but I think we could get a healthier understanding when we utilize more equities. So definitely going to start with that and see where that goes, and then kind of go from there.
Yeah, no, definitely. And don't forget too, it's just like correlation's obviously good, and from a statistics perspective, like we want to show that stat
Mhm.
API, but yeah, I mean, like they go hand in hand. I'm about to contradict myself. I was gonna say like maybe like showcase like the spread of returns, on every monthly basis or every yearly basis could also be valuable because like yes, we care about the correlation, we care about the directional nature of it, but we also like we want the returns to at its core like to be the same, And I know we're not gonna get them perfectly the same, but we want them to be. The assumption is like when you can optimize your factor betas and your exposure in your portfolio to be exactly the same factor, like the hypothesis is that they should be the same return. So like correlation is really cool to see, but let's actually just show like both returns and like show a delta between the returns, and then maybe we plot like the delta over time.
No, that's good. Yeah. Yeah. Okay. Yeah, I wish I included that. I was trying to think of something else to work to kind of give a better intuitive appeal on some of the graphs because again, like I just think they almost take away because it's like just eye test. It's hard to actually see, but that would have been good. Just a delta return
Yeah,
graph.
and
Okay.
it's cool because you can do it on both. You can crack it. You do two lines, whether they're on the same chart or different. However it looks after you do it. But like one line is the delta of the S&P 500 and the Nifty 50 before you optimize it. One line
Yeah.
is the
Yeah.
delta
Yeah.
in the Nifty 50 after you optimize it. And you should
No,
just
that.
see
Yeah.
one line be like smaller than the other line.
No, that makes a lot of sense.
Yeah,
Yeah,
and
that
do
that'd
it
be
on an
good.
absolute basis too. I would think makes more sense. Like, don't care if it's
Mm.
positive or negative.
Yeah, yeah, it's irrelevant essentially. Okay, no, that makes sense. So, assuming we, so yeah, so our optimizer, we've talked about this a little before, but there's 500 stocks to choose from. Typically, when we're working with our main S&P 500, it'll go from 500 stocks to anywhere between 30 and 40. And the logic behind that is when you're trying to align to just a specific beta point, there's going to be probably, I would say, 30 to 40 stocks that are pretty close. So then it's easier to weight those around. But now we're just trying to expand our optimizer and utilize more equities. Obviously, it'll compromise like computational and stuff like that, but kind of negligible for this case. We're just trying to experiment with it, play around with it a bit, and see if when we're working with more of these equities, if it improves correlation. So if we can get, I guess you could say, any type of advancement in correlation, then I'll probably we'll probably do something pretty similar in 2 weeks from now, and then try to include some of those things like delta return stream. That would be good. So I hope we can get some more correlation to get back to that. Because yeah, this stuff is really interesting. And I'll be honest, I wasn't expecting correlation that high. I thought it'd be better, but when you go from zero point zero 0.07 to 0.67 to zero point 0.6 improvement, that's great to see, honestly. So
Yeah,
yeah,
it's one of those like expectations reality. Like we shoot for the stars, we have a hypothesis. Like it's always good to level set. Like it always
for
takes
sure.
multiple troubleshooting iterations to get to that point. Like everything goes little and little.
Yeah, I mean, this also took a while. It just didn't seem like it because we didn't meet for like almost 6 weeks. So then, I showed you the presentation 2 weeks ago. That was from 4 weeks before that. So we've been working on this for like 4 or 5 weeks now with all the data cleaning and gathering and all that stuff. So definitely difficult. And then, yeah, like say one thing, like, well, it would be easier using the Nifty 50, where it's only the 50 biggest equities. Well, if we're trying to use more equities, why not just use an index from the Indian market with more equities, and then you can still slim it down and be utilizing more equities? Well, there's literally no other indexes that we can get for the Nifty or for the Indian market because of liquidity and privacy and all this stuff. We were looking for a while. We literally couldn't get anything else, which is kind of unfortunate. So, our next idea was to just adjust our optimizer, use all 50 equities instead of, 8 to 12. So we'll go from there. But yeah.
Yeah, but no, it's awesome. It looks great. We're definitely making progress. This is definitely like research. Like it's funny,
Mhm.
like the last part of the project, like still interesting, still something that we can continue, but that was more just like practical experience to industry. This is
For
more
sure.
like research, but this research is like really interesting, valuable research that like could be published and cited and like, you know what I mean? Like show
Mhm.
once we actually like fine tune it and like touch it up a little
Yeah,
bit.
no, that's always the goal. I mean, while we have the time, so if I'm not mistaken, we have meeting in 2 weeks, and then 2 weeks after that, quant conference. So obviously, we'll get some stuff for 2 weeks, and then aside from that, we'll probably be starting to focus on our presentation, at least for those 2 weeks, maybe a little bit extra before our next meeting. Do you have any, specific things you think we should work on after the quant conference going forward? Because obviously, we can improve this stuff, just kind of play it a little by ear, but I don't know if you have anything in mind that might be interesting to work on. Because say like for one, like I've like thought about a lot, like almost, and this is a kind of a huge change. So that's why I clearly like specifically just thinking about, but say like almost just working in it to be of a more of a multi-asset, multi-factor model. Say if we worked in bonds or anything like that, that's a huge change. So I'm not gonna, go and do that on a limb, but stuff like that. Do you have anything specifically that you'd be interested in us working on? Because we can kind of take it wherever. So
Yeah, it's a good question. I mean, like, I brought this up a number of times over the years, but never like recently. I guess never to like your cohort. But like, I'm just here as a sponsor. So like, if there's any direction you guys want to go down, like, I support it. I'm here to guide it. I'm not here to like
Mhm.
dictate the direction.
For
So like,
sure.
if it like, so my answer is like, I could give my opinion, but like, if you want to explore multi-asset, like, I'm not gonna say no. I'm fully in support
Yeah,
of
I,
like doing.
I mean, I guess I just want your opinion of what would be interesting. I mean, like, I would say honestly, like, I don't know too much about like most fixed income stuff. I want to learn about it, so that's almost like selfish for me to be like, okay, let's work on bonds now. So I don't want to just like dive into something. Obviously, team opinions and everything is important too. Like, we'll consider that. But if you have any opinions, I'd be happy to hear them because kind of go
Yeah,
wherever.
my opinion would be if you have two options in my opinion. You have the if you have the ability to expand on what we already have here and like specifically on like making it more correlated or getting like the reinforcement learning model to be like more predict like more accurate or like maybe like fine tuning it and changing some conditions or constraints, sure. Or you have the option to go a separate route, like explore bonds or something else, but you want to make sure that it's still additive to the current existing portion of the project. So, for
For sure.
example, when John got involved and he really was really invested in wanting to do like the futures and like the tax laws
Yeah,
harvesting,
yeah, yeah.
I wasn't like against it, but I made it kind of clear. I was like, as long as like you keep pulling it back and making sure it's added to the portfolio, added to the project, and like what you're doing does connect and contribute to it, like that's fine. And like there were times when he did that where it was like they kind of got sidetracked and they kind of got lost in it, and they were just like, how do we bring it back to like make it connect? So it's just like learning from that experience, like if you want to add something to the project, you can. You just have to like think through strategically, like how do we make it additive to what we've already been building upon the past few years.
I guess that's where the whole like logic from like bonds per se comes from. Obviously, I'm interested in working on it, but I also at the same time, I know obviously I kind of focus a bit more on Sortino, but the overarching thing is kind of downside volatility. Well, if we're trying to get good downside volatility, bonds are like way better. So I'm almost just like, well, why not just work them in? Obviously, that's not just work them in. That would take us probably months. But as far as spring semester goes and stuff, definitely thinking about that because there's some things we need to do. Say we need to improve our dynamic monthly rebalancing. We need 60 different CSVs of points just for our standard 5-year runs. We got to generate those, hopefully on the LTS desk where it can run faster. And then we also got to do some other things, try to improve correlation. But I guess as I'm kind of thinking more long term, what could we do that would be like something that would keep us busy, so to speak. So yeah, I'm just kind of just talking
Yeah.
about things to explore it. But yeah,
Yeah, I
that makes
agree.
sense.
Again, it now kind of goes down to the direction. Like my take on this is just like you guys have done all the groundwork. We have this optimization model that you
Mhm.
get whichever factors you want in your portfolio. Very valuable. I know you guys didn't even work on that, like to build it. Like that was like years ago, but like
Yeah,
you adapted it, right? You have that. Then you have this reinforcement learning model that not only allows that is built off of that because now allows you to actually predict what would be the optimized how to minimize downside volatility to optimize your beta by using these new factors, right? So that's like one component of the project, which like works kind of well, but it's weird that the monthly is not better than the yearly. You could work on like making it more dynamic. So it could be like, right, I don't want to just minimize downside volatility. I want to maximize expected return, or I want to like minimize our tracking error to a benchmark. There's like different objectives we could change
Mhm.
hypothetically to fine tune it while still like rebalancing your betas. You could change the conditions. There's all that side. Then
Yeah,
there's this
yeah.
recent side of being like, all right, like we have our hypothesis, we have this optimization beta model to allow us to explore this hypothesis. If we are right with what we believe in, we can generate pretty much the exact same returns between two entirely basket of stocks. That itself is like really, really interesting. So it's just like take both routes. Like the first route, really interesting from like a resume stamp, right?
Yeah,
Like data
exactly.
optimization resume. This one's still in that category, but like less practical in terms of like industry and more of just like I think like you go down this rabbit hole, it's like you get a nice paper down the line, you get cited, you get published, like it could go a long way. If you wanted to go down exploring like the bonds or like different multi assets or other stuff like that, I think like by all means, I think that contributes to the first half, the former one, where it's like just boosting like from a practical sense, like the type
Mhm.
of project. So it's just like it comes down to like what route you want to go to. You know what I mean? You want to keep messing
Yeah.
with some interesting stuff that like could hypothetically be used in industry, or do you want to really like narrow in on like a paper that like could be published because it's like research that nobody's else done?
Mhm.
And again, as a sponsor, like whatever you guys want to do, I support.
Yeah,
It's
yeah.
more
No, yeah, thank you. I just wanted to I guess just gauge, yeah. So I appreciate that. Yeah, because like I was saying, like and you're saying, there's a lot of ways we could take it. So it's almost like hard to decide because there is a lot of things, and obviously that's a good thing because we could take it a few different directions, no problem. So yeah, thank you for that. So definitely we'll think about it going forward. And this isn't like I'm not talking next week. I'm talking, at
yeah.
least a month out. So just wanted to hear your opinion, sir. I appreciate that.
Yeah, of course. It's one of those I like saying this analogy. It's like it's a good problem to have. Like
Exactly.
there's
Hmm.
there's no wrong decision in whichever route you take. It's just whichever
Yeah.
one you want to continue exploring.